Good morning, everyone. Welcome to this update for global stocks and commodities for the 1st of March. This will be a bit longer, this edition, for obvious reasons. Lots of things to talk about, and I guess we all have a great deal of questions about how this unfolds from here. So I'll do my best to provide a perspective rather than some sort of panicked view, which we're getting from a lot of the media at the moment. Yeah, I think the overwhelming thought that I got to the end of the week with, which was a brutal week. I mean, it taxes the psychology of even the most experienced market players. But the overwhelming thought that I had into the end of the week was just look at the possibilities, just look at the opportunities in some great stocks. So I'm actually feeling extremely positive and extremely buoyant about the possibilities as I reflect on the week that's just gone. So let's jump into it. It's been a huge shock this week to people's psychology, obviously to the technical setup of the market, all those sort of things. But the bottom line is that we've got great stocks that are producing great results, and they've just gone on sale. And that's, I think, one of the things that you need to focus on, not a lot of this other stuff in the media, which is just all about it's a global pandemic. That line just seems to be getting rolled out all the time. But what we've got to do, because it's so unknown and so uncertain, is we've got to manage risk. And it's not just managing risk in the traditional way, it's how you go about it. We just cannot know how the virus is going to spread. No one knows that. And the second thing we don't know is that how markets will react to that. So this is very much about managing risk according to what your psychology can tolerate. And everybody's different in that respect. Through the week, from various members and non-members, I've had both ends of the spectrum. I've had people that are really quite relaxed and, in fact, sending me emails about buying stocks early next week. And yet I've had, at the other end of the spectrum, I've had people that have said, well, is it time to throw in the towel and go away? So everybody's different in that respect. And so it's so important that you understand who you are and what your psychology can tolerate. But certainly I don't think the case for, chucking in the towel exists for anybody. I've been in the market for more than 3 decades. And one thing that I've learned is to play it as it comes and not to try and form an opinion on something. And I talk about this every week. Just play the ball as it comes down the pitch. Observe and respond. And that's the biggest thing that I've learned in decades in the market. So yes, we should be wary according to our own psychology, but just to dump everything and run and hide is just not the way to go. It just isn't. There are too many good businesses out there. We've got too much unbelievable technology. I mean, go back and watch the video that I did last Sunday before all this fell apart. Now, the world hasn't suddenly changed in 7 days. So there's just too many good things going on out there for there not to be tremendous opportunities. And for those who were invested in the market in 2008 directly, just consider the sentiment back then. It would have seemed inconceivable how the market went up threefold in the next 12 odd years and how economies rebounded. And the same thing's going to happen again. So you need to be thinking about possibilities and not wringing your hands about all the media attention that where this virus might go. So having said that, let me move on. There'll be some stock and commodity trend updates, but obviously a lot of this is sort of big picture perspective. Now, last week in Portfolio Analyst, I did deal with the virus because that was Wednesday and we were already halfway through the week, so it was pretty obvious what was going on. Talked about the gold stock strategy and also did a review of US recommendations as well. But obviously a lot progressed after that. Now, just some reality on the virus, and I don't profess to be an expert. I'm just picking up some figures that I believe to be factual from people that I follow who have proven over the years to be extremely level-headed and pretty objective in their comments. So let's look at some reality. In China, the day over day, so that's from one day to the next, the net case growth has been negative for 5 of the last 6 days. Now, I know that you can make stats say whatever you want them to say, but my understanding is that that's a fact, and therefore there may be some evidence of containment and slowing. It's also a fact that tens of thousands of people in Hubei province who had contracted the virus have now recovered, or are officially classified as recovered. Now, again, a bit of a qualifier there. Can we really trust the stats that any governments are putting out? And the answer is, we probably need to be a little bit skeptical. But there's probably no doubt that people are recovering. And 31% of all cases have already recovered. And 3.1% have died. But there's still, 97% of people haven't died. So, these are the facts as I understand them. What has really set the market off and social media off is the growth in the number of cases outside of China. And yes, that's happening. And we've heard about Italy and we've heard about Iran. But how significant is it? In the UK, there are 15 cases that have been reported in a population of 67 million. Hong Kong has 93 cases, 2 deaths in a population of 8 million. Now, again, there could be some underreporting going on here, but when you put this in the perspective of typically, and this is what I have heard anecdotally, that there is something like 500,000 deaths from influenza every year around the world. That never gets reported. It's just accepted as, well, that's par for the course. So, let's keep this virus in perspective because it really, there's a lot going on in social media that is stoking fear. So let's just keep it in perspective. Now, I'm not trying to downplay it, but just in the spirit of trade what you see, what's in front of you, make decisions based on the facts. They're the facts at the moment. Now, this virus could get a lot worse, but then again, it may not either. So, let's not bake in worst case scenario. So from an overall perspective point of view, the virus impacts are pretty unpredictable, but they are unlikely to cause a bear market. Now, I had originally written will not cause a bear market, and I don't believe the virus in itself will cause a bear market. But I did shift the wording of that because the only thing that does concern me a little bit is the policy response from government. Will the containment attempts actually backfire on the global economy? Will they be too severe? Will they interrupt global supply chains too much? So I don't think the virus presents that big an issue. I think the biggest risk is that governments just go too far, that they just shut down economies, and that leads to a recession. But providing that governments don't go over the top, then we should be okay, because none of the precursors for a recession are present. They just aren't, and I talk about that periodically. And on top of that, there's going to be massive central bank stimulus. We've already seen that in China, and it's almost certainly going to happen in other countries around the world. And that injection of liquidity into economies, that money has to go somewhere, and it finds its way into asset classes. It finds its way into the equities market, and there are very, markets are very complex. There are many unexpected pluses and minuses coming from sources that people aren't aware of, and this is just one of them. Just as an example, the Swiss central bank has been trying to defend their currency from getting too strong for years and years, because then it really impacts their economy. And one of the consequences of that is that they've been effectively printing money, and that money has found its way into the US stock market, particularly into ETFs. So that is just one of numerous additional sources of buying that makes this balance between supply and demand in the market extremely complex and extremely unpredictable. So in the last week, what has happened is that the algorithms took over, the buyers stepped back, and the reverse ETF spiral that I've spoken about on many occasions, I guess everybody understands or should understand that the ETF market to a degree has gone up without any valuation judgment being applied. It was just momentum feeding on momentum. But it's also possible that that momentum can reverse and go the other way. And I think we saw a bit of that in the last week. So as I said earlier, perhaps the biggest risk to all this is that containment measures go too far, that economies get locked down, and we do end up in a global recession. But that really shouldn't happen, because the facts at this point in time do not support this virus being worse than any other virus. It may end up being worse, but again, it may not. So why would you worry about something that may not occur and hasn't happened? It's just not logical. Great businesses will prevail and grow. That's the bottom line. Always have, always will. So all you need is some patience, some clarity about what you're doing, understanding about your psychology, and having a bit of a dash of courage. And it's quite probable that I'll be doing a little bit of buying tomorrow. Because I'm just, observing the market and I'm responding. And what I did see was a massive reversal in the US market on Friday night. So more about that when we get on to that part of it. So I'd really encourage you, stand aside from the panic and use the panic to advantage if you want to succeed. People are throwing some of the world's best stocks out on sale at the moment, and, the prices will rebound. Now, if we look at it from a purely technical point of view, so putting aside the fundamental common sense, there's been a lot of technical damage done to the market, as you'll see in the charts in a minute. And this was undoubtedly forced selling to meet margin calls. There's no other explanation for the price action we saw last week around the world. It was quite extraordinary. This technical damage, the breaking of the 200-day moving averages, it needs to repair fairly promptly. Otherwise, it can become a bit of a self-propelling mechanism where, because the indices are below the 200-day moving averages for more extended periods, then that brings in additional selling. But I do note that we did see a massive rebound, and I'm talking huge, and accompanied by an incredible increase in volume in the last 2 hours on Friday night in the US. And that also corresponded with a peak in the VIX that exceeded the peak that we saw in 2008. Now, that is just not logical. The situation we find ourselves in now is light years better than what we saw in 2008, where the world's financial system was broken, seriously broken. And for the Vix Index, the fear index, to now be higher than it was in 2008 is just silly. And that's one of the reasons that I think this has been a massive overreaction in global stocks. I think what we can expect from here is that the volatility is going to continue. Almost certainly not at the level that we saw last week, because that's, the human brain just can't take that. It just gets fried by it. And so people stop, buying and selling in that manner. So yes, we're still going to see volatility, but I think what we're probably going to see is a consolidation for some weeks at a minimum. So I think it's a good chance for a few weeks. We've seen the lows, but whether the market goes lower from here than what we saw last week will depend very much on how governments deal with the situation, I believe. So let's look at American stocks. The S&P fell by 384 points, 11.6% in the week. It's the fastest correction being 10% or more. It's the fastest correction in history. The VIX at 49, an overreaction, you bet it was. Completely unwarranted. And the VIX finished the week still high, but came well off that, was back down to about 42. there was a very significant and very high probability reversal on Friday night that we'll take a look at in a minute. So there should, at the very least, be a short-term rebound. But I wouldn't be expecting a new all-time highs for some time. I think forget that one. It's not going to happen. But what we are going to see, I believe, is a volatile range. The US dollar lost ground, pulled back to 98.13. And the 10-year yield fell sharply, really sharply down to 1.13. Remember, just 2 years ago, the 10-year yield was at 3.3, and people were talking about it going to 4%. And now it's down to 1.13 as the money went into the bond market, and that is the lowest yield ever on the 10-year Treasury. So, quite extraordinary moves that we saw last week. All right, let's look at the charts. This is the S&P, and let's wind back 3 weeks. So when we had this day here, I said it hadn't broken the 50-day moving average yet, and until it did, then we just stayed with it. Now, we then got a massive gap down on Monday. That was the signal that something else was happening, the huge gap, change in pattern, and I recommended to members that we start to create some cash. So to me, that was the appropriate reaction. Not doing it here because of what might happen, because this may never have fallen apart last week. So wait until the market responds, and then we do something about it. Now, as it turned out, you can see just a terrible week, down every day, big gaps, hugely negative on Friday night. And this really was the capitulation selling, because at one stage, this green candle was a massive red candle and the worst of the week, and on high volume as well. So this was the real capitulation move in the market. Now, I want to take you through something again for perspective. This is the S&P 500 on a monthly chart, and we're now looking at this section from 1977 to 1990, and I just want to show you that at the end of the day, the markets always end up going higher. So that's one reason why you shouldn't panic over what's going on. So here is October 1987. So went down for a couple of months, and then in about 10 months, the S&P was actually trading higher. Now let's just walk through all of the events. Start to see 1987 in perspective as we go further along the line. This is 1994, which was sort of bit of recessionary conditions, and then we ran into 2000, the 2000 to 2002 bear market, where the S&P fell from 1550 down to 800. This is then 2008, the GFC, where we fell from 1560 down to 700. And then that brings us up to date to where we are. Now, if we take a look at the whole slice of this, so markets always recover. Now, the situation we find ourselves in at the moment, to my mind, is nothing like 1987, 2000, 2008, or even as bad as where we were at the end of 2018, when markets were freaking out because central banks were raising interest rates. The situation we find ourselves in now, from a purely financial impact point of view, is not of that ilk. So please keep things in perspective. Okay, I just want to look at a few other charts as well, which are helpful. So this is the Nasdaq QQQs, which is the ETF covering the Nasdaq. So the Nasdaq hasn't breached the 200. The Nasdaq hasn't breached the 200-day moving average. The S&P did, but and you can just see the massive volume. And if I was able to show you an hourly chart on these indices, which I can't do in this charting package, you would see just what an incredible recovery there was in the last 2 hours on Friday night. It really was quite breathtaking. let's look at the China index, and this one is a real head scratcher. So here's the China index. There's been virtually no response. Okay, well, I mean, we've pulled back a bit from the highs that we formed in January because of the virus, from 560 back to 410, but we're at the same level that we were at in 2016. So the Chinese market didn't fall apart last week at all, like other global markets had. So I find that really quite interesting. Now, I just want to look at a couple of other stocks. So let's look at Alibaba, for instance, which is the biggest Chinese stock. I mean, just look at that chart. There's hardly, you wouldn't call that fear and panic. We're only just under the 50-day moving average and got nowhere near the 200-day moving average. Let's take a look at FDN in the States, which is an ETF that covers stocks like Microsoft and Apple and all those sort of Facebook and Google. Yes, we breached the 200-day moving average, but a big reversal on Friday night. And if you go through hundreds and hundreds of charts, as I did on Saturday morning on US stocks, you see this same pattern everywhere. These massive reversals in US stocks. So I think we can probably look forward to a reasonable rebound attempt next week. And there's the Vix Index. Now this is showing close levels, but I can tell you that it did spike to 49 on Friday night. All right, Aussie stocks, the Aussie dollar sharply lower, just barely holding on to 65 cents. It's broken key support. Next supports come in at 60 and then 50. So the Australian dollar in all sorts of trouble. Our index down nearly 700 points, just under 10% fall last week, and absolutely nothing got spared. There was nowhere to hide. High PE stocks suffered the most, and that has certainly got a lot of people being very anxious. But look, at the end of the day, these are the growth businesses. This sort of thing always happens. High PE stocks get smashed when there's a panic, but equally they rebound very quickly. This is pretty normal. It's the risk that you take for being involved in high growth stocks. It's volatility risk. But it really is more about managing your psychology than anything else. Now, a few growth businesses did miss quite lofty expectations in the market, but that's just a transient situation because a lot of these businesses, they're reinvesting for growth. So from time to time, they are going to miss, they showed great growth, but they missed expectations that the market had, which had been really quite extreme. But growth stocks are still the place to be. You've just got to learn to deal with the volatility. So that's why it's much more of a psychological question than a question about which stocks you're in. And I've been saying this for months and months now that, I would much rather be in growth stocks because growth really allows you to get out of any difficulty that the general stock market might be in or an individual business might find itself in the short term, whereas some defensive stocks are going to be in real trouble. Okay, let's go in and have a look at the Australian market just for the record. So this is the ASX 200, a huge fall, smashed straight through the 200-day moving average, and we're now exceedingly oversold. But look at the volume on Friday. This was, again, real capitulation stuff. Let's just quickly run through the indices. Energy, just a shocker. Finance, not quite so bad, but still quite emphatic. Healthcare, doing best on the back of companies like CSL and ResMed. This is the materials sector, also hit very hard, BHP and Rio. And if we look at the small caps also, so really across the board in Australia. Okay, let's go and look at precious metals. Now, gold crashed $60 across the week to $15.85, and that is pretty unexpected because we would have thought that gold would have done very well, and it did earlier in the week. But basically all of the previous week's gains of $60 are gone. And, why is that? Why didn't gold do much better given all the fear? And I think the obvious likely answer is that there were margin calls. We know that the market is heavily leveraged. So there were margin calls elsewhere, and we saw this in 2008. People sold whatever they could sell to get liquidity to meet margin calls, and gold just happens to be one of those assets. And we saw it for a while in 2008 where gold was sold as well. So that started some selling in the gold market. And then the other thing that I've been talking about for months, and this is this overhang in the futures market, finally found a trigger. And so the futures overhang started to really bite as well. And we may see further downside in gold because of that situation in the futures market. But it doesn't change the fact that the main trend in gold is up. Gold outperformed the S&P index in 2019. So, that's where the trend is. So this will set up a great opportunity, but I certainly wouldn't be doing anything about it just yet. On top of that, we're heading towards a seasonally weaker time of year for gold, which is May, June. And then, we get an acceleration in June. If we look at precious metal stocks, just don't try and fight the seasonality and the short-term trends. Stick with the very highest quality stocks because that's where the safety is going to be, and use volatility to benefit. Have some cash and buy into some of these stocks when they're getting really beaten up fairly badly. So let's look at the gold market. This is the daily chart, so you can see most of the selling happened on Friday. We were obviously very buoyant on Monday and hit a high of $16.90, almost $1,700. Held up pretty well through the week, and then Friday was, really the big capitulation in the market, in the stock market, and probably margin calls. So gold got sold. If we look at it on a weekly, you can see we're still, whilst it was a big move down for gold on the week, we're still in a very steep uptrend. So that's the situation for gold. Let's look at GDX. So this is the weekly, and that looks really seriously ugly for GDX, and most of that negative effect happened on Friday, or Thursday and Friday. So gold stocks started selling off Thursday, and then that followed through on Friday. So that's our situation with precious metals. They're still in uptrend. They'll present a terrific opportunity, but when margin calls start getting triggered, you don't want to stand in the way of that because that just has to play out because it's forced upon people. They don't have a choice. So all sense of what should be logical and what is value goes out the window. So don't stand in front of a sell-off due to margin calls. All right, let's move on. Other commodities. Copper crumbled down to 2.51 for obvious reasons. The big picture remains pretty supportive, but obviously in the very short term, all bets are off at the moment with respect to the global economy. Crude oil also got belted down to 45, and no prizes for guessing why there. Okay, there's spot copper chart, and there's the spot nickel chart. So selling across the board. So to wrap it all up, these are my final thoughts. And sorry, this is a bit of a long edition, but look, I know that there's a lot of questions and a lot of confusion and a lot of anxiety out there because I've been fielding the questions all week. So I wanted to make sure that I covered as many bases as I could, and I gave you as thorough an explanation of how I'm seeing things and how I'm seeing the opportunities as I possibly could. The best stocks will rebound readily. They always do. There's no question about that. Now, there were a few stocks that hardly fell, and that tells you something. In the States, for those that want to go and look at some charts, have a look at the charts of stocks like Atlassian, which is an Australian stock listed in America. The code is TEAM, T-E-A-M. Hardly fell at all. If you look at a stock called PDD, that in fact I think went up across the week. Alibaba hardly fell at all. So that tells you something on a week like what we've just had, that if those stocks weren't going to fall in that sort of environment, then there's some pretty damn good underlying buying support. So, look for evidence of stocks that were highly resilient to the selling last week. In Australia right now, we've actually got the advantage of earnings season, because just at a time when we desperately need to know how our successful growth stocks are going in Australia, we want to know right now how those businesses are going. And we're right in the middle of earnings season, so we've got the most up-to-date information. Now, all those stocks got sold off, but in almost all cases of the stocks that I'm really interested in, and my highest conviction stocks, they not only showed remarkable growth, but they beat market expectations. Now, that didn't stop them getting sold off heavily, and that's uncomfortable. I get that. But great businesses will prevail. And what's happened now is that great businesses are now a heck of a lot cheaper. So you've just got to try and put aside what happened last week. Now, I know that's really a difficult thing to do, but you've just got to do it, because what it does, it just messes with your head. It really clouds your thinking and your ability to make objective decisions. So try and put aside what happened last week. It happened. Let's get on with it. Let's focus on the possibilities, and there are truckloads of them. I made a list over the weekend of stocks in Australia and America that I would want to buy, and the list is ridiculously long. So focus on the possibilities. These are some actions that I think you should consider taking, and bearing in mind that everybody's psychology is different to a degree, so you've got to line this up with your own psychology and make your own decisions. But one thing that applies to everybody, if you've got a predetermined bias, then try and lose it, because it's just going to hold you back. If you're fundamentally a bearish person, if you look for bad news stories, then you just got to try and get past that, because it'll really hold you back. So, any sort of predetermined biases, try and get rid of them. Just learn to play it as it unfolds. It is always the best way to go in the market. Don't try and anticipate how bad things might be, because you've got no idea. Raise some cash for attack purposes, and that was what I was recommending to members last Monday. Follow the approach that I discuss every single week. Have a big enough, robust watch list of quality growth stocks. Then be patient, wait for dips, wait for reversals. We probably need to wait for bigger dips and more significant reversals given the week we've just had, but it's still the same process. Be considered, but be decisive in what you do, because great opportunities, when we get selling like we had, they don't last. You don't have a week to think about this. We could well get a flurry of buying on Monday. Maybe we will, maybe we won't. I don't know. But we could have an absolute flurry of buying on Monday and Tuesday. You don't have a week to watch and think and make up your mind. You've got to be decisive. Focus on the best individual stocks, not the index, because the really good stocks will outperform the index by a country mile in the next few months. Portfolio analyst upcoming is really about making sure that we've got that list, and we're deploying capital as opportunities present. So to be honest, I'm excited about the possibilities. I really am. I'm cautious. I'm somewhat conservative, but I'm excited by the possibilities, and I think everybody else out there should be as well. But you need a tight game plan to do that. Otherwise, you might get yourself in a bit of a mess. But look, it's going to be another fascinating week, and we'll see how it unfolds. That's it for this week. Cheers.